We've talked quite a bit about some other areas when it comes to the different types of securities or investments that you can make in debt and or equity, the methods of accounting for those, and we're going to look at just a few other things that come about as the result of investments in securities potentially. So one is the fair value option. You may recall that companies have the option to report most financial assets and liabilities at fair value, with gains and losses reported in net income. The fair value option is only available at the acquisition date or date incurred for a liability and applies on a security by security basis. When the fair value option is selected, it must be used for the life of the instrument. So the company must continue to use the fair value option as long as they continue to own that specific security. When the fair value option is used for available for sale debt securities, gains and losses related to the changes in the fair value are reported as part of the net income rather than as a part of the comprehensive income. And equity method investments. The investor does not report its share of the investee income or loss, rather changes the fair value of the investments that are reported in net income. Likewise, the receipt of dividends is recorded as dividend revenue rather than as a reduction of the investment account. Let's take just a moment and look at this for an available for sale debt security. We have McCollum Company, who purchased stock in Fielder Company during 2017 that it classifies as available for sale. December 31st, 2017, the cost of the security is $100,000. Its fair value at December 31st, 2017 is $125,000. If McCollum chooses the fair value option to account for the Fielder Company stock, it makes this entry on December 31st, 2017. It increases the equity investments by $25,000. That is the difference between the cost and the fair value. And it recognizes in the unrealized holding gain or loss income account $25,000. Now let's look for an equity method investment. Sullivan Company holds a 28% stake in Supin Incorporated. Sullivan purchased the investment in 2017 for $930,000. December 31st, 2017, the fair value of the investment is $900,000. Sullivan elects to report the investments in Supin using the fair value option. Remember, it's on an investment by investment basis. The entry to record this is unrealized holding gain or loss income of $30,000. and an equity investment credit of $30,000. Remember, in this case, it's actually dropped in value. It has not increased in value. Be sure to read the evolving issues that are around things such as fair value. Fair value really is something that can be a little contentious, as is some of the multiple ways that we can account for things such as a variety of instruments. Not everyone is in support of these different ways that we can actually go about reporting an investment. Think about debt investments and the many different ways that we can report them. They come through as held to maturity, available for sale, or trading. And to add to that, for just a little bit more confusion, it all relies on intent. And intent is not necessarily something that is black and white. It's not like it's a dollar value. And as we spoke in the prior videos, intent can change. Something can change. It's very subjective. The more subjective something is, the less clear and transparent it could be. Not necessarily is, it could be. So with that level of subjectivity in it, we can get some arbitrary classifications that may or may not be right. So continuing to talk about fair value. With fair value, there may be some type of an impairment in value, or there may be a permanent impairment in value on a security that we're holding, such as a held to maturity bond. The rules for debt investments, so we're talking about debt securities, bonds, loans, is that they're reported at amortized cost following the same approach as we discussed in Chapter 7. That is, companies should use the current expected credit loss model to record the impairment of the debt investments, similar to that of receivables. This is if a decline is judged to be other than temporary. The cost basis of the individual security is written down to a new cost basis. The amount is then accounted for as a realized loss. For debt securities measured at amortized cost, such as bonds that are held to maturity, a company uses an impairment test to determine whether it is probable that the investor will be unable to collect all the amounts due under the terms of the transaction. So let's take a look at Strickler Company, who holds held to maturity bond securities with a par value and amortized cost of $1 million. The fair value of the securities is $800,000. In evaluating the securities, Strickler has determined that it's probable that it will not collect all of the amounts due. In this case, it reports a loss on impairment of $200,000. Strickler includes this amount in income and records the impairment as follows. They recognize the loss on impairment, which is going to flow to the income statement of $200,000, and then they reduce through a credit the debt investments $200,000. Companies that have debt securities that are classified as available for sale use a different impairment model. Under this model, if the fair value is greater than amortized cost, no expected credit loss is recognized. Impairment losses on debt securities that are available for sale are limited to the difference between fair value and amortized cost. So to illustrate that, we use this particular chart. Illustration 1718 shows an impairment analysis based on these types of impairment guidelines for Alexander Company. We have situation A, B, and C. So for situation A, they have an amortized cost of $1 million. There's a fair value of $960,000. An expected credit loss of $110,000. They can only take an expected credit loss to their net income of $40,000 because that is the difference between the amortized cost and fair value. In situation B, fair value is an amount of $860,000. Amortized cost is $1 million, but the expected credit loss is only $110,000. Therefore, we will take the expected credit loss of $110,000. We recognize that as a loss on impairment, and we credit an allowance for impaired debt investments. Now, finally, in situation C, amortized cost and fair value are the same because there is no difference between the two of them, and the expected credit loss does not exceed that difference. We would not take an impairment at that time. This is a great little illustration for you to show you about impairment and how we go about asset measurement basis or impairment model to determine impairment.